Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with the three amigos. How you doing, Matt?
Doing super awesome. Ready for to cover this topic.
There you go. And Dion, how are you?
Howdy, Mike. I'm doing great. I'm ready for round two. You have to be really careful saying stuff that makes me and Matt's inner 5-year-old laugh just before you hit record. You can't go. It's going to get bigger.
I know it's lunchtime here on the East Coast. I'm thinking about my lunch is going to get bigger. It's going to be bigger.
Yeah, I'm sure that's what you're thinking about. Oh, funny. Hey guys, I don't know about you, but I've started to see more crash videos, bubble videos.
Yeah.
I've seen more people talk about the Dallas Fed is talking about a bubble. all these videos talking about real estate getting cheaper. That's what people are saying. And I got to tell you, if I was, asked to pick, I don't think I would be on the cheaper side. I think there's a set of dominoes that could fall, and we're going to talk about all of them here, that would make the single family home not cheaper, but would make it wildly more expensive, right? So when we look at this scenario, I want to talk about things. Again, we are not making predictions here. We are going to just say these things could happen. And if any of them do, prices are going up. And if all these happen, prices are going way up. So Matt, I think I started with Dion first last time. So we'll go to you. You want to pick something first that could make prices go up, up, up?
Yes, 40-year mortgage.
Now, why would that make it?
I have no idea. It's just math.
It's just math.
Just math. I mean, basically, at the end of the day, they're talking about making that widely available. If that becomes widely available, the first 10 years are interest only. Interest only means no principal pay down. It's going to create a whole set of pukey circumstances in the market over the course of the next 10 to 15 years. But just looking at just the 40-year mortgage, even they'll be able to keep the rate at a certain level, potentially even the same as a 30.
Everyone I've seen to that point, I've looked this up, is the same as the 30. Rates are the same.
So if you're exactly the same as a 30, you're basically taking, I think it's about 20% off of your payment.
12%.
12% off your payment.
Yeah. Not that I've done the math, but
yeah. So that's one of the things I was looking at, which was for us, it was, it's going to take a bigger percentage off in my state because of our taxes.
Oh,
so our taxes are such a large portion of our payment that for our state, it's actually going to take about 20% off.
Oh, wow. Okay.
So what does that mean for our market that went from 300 to 440 in 1 year for a median house?
Yeah.
That means $500,000 house is now your median house.
Yeah. So you're absolutely right. If the 40-year mortgage comes out, I shouldn't say if, when the 40-year mortgage comes out, there are a couple of caveats to it. First, I fully expect them to only make it available to homeowners, and they could possibly start it homeowners, first-time home buyer. What do you think of that?
Yeah.
You see that? Yeah.
Yeah. I think, I mean, they are not going to be rewarding multi-home owners.
No, they're not going to, it's not going to go to investors. But here's the deal.
Doesn't really fit their criteria.
Yeah. So domino number one that we've discussed, if the 40-year mortgage comes out, who benefits? Homeowners benefit. If you already own your home and you bought it on a payment of 30-year, and then suddenly the standard becomes 40-year, every new house will be sold on a 40-year payment versus 30. Your home has gone up somewhere between 10 and 20% in value, and it will be almost immediate.
Yeah.
Right. So the 40-year mortgage comes out. It does not make housing cheaper. It just doesn't. Dion, you're next. What do you got next?
The moment that's announced, if I had a house on the market, I'd take it off. The moment
for sure.
It was announced.
And hold it back for six months. And
even just even like 30 days, just hold it, because the frenzy will be ridiculous. Yeah.
All right,
and the
Dion?
problem with the 40-year mortgage is any homeowner that's probably going to sell within 5 to 10 years is really setting themselves up for pain.
Correct.
The thing I think that's going to cause prices to go up is the thing I hate the most. The adjustable rate mortgage.
Oh, no.
The lender that says, look how much you can buy if we lower your payment now for at least 2 years. Like 2 years, rates will probably be down in 2 years. And I know that there are ethical lenders like Matt, the mortgage guy, who says our firm or agency or whatever they're called is looking at, can you afford it when the rates adjust to what they can adjust to in the future? But that's not how all lenders are going to do it. They're going to say, let's do this adjustable rate mortgage. Let's just do an adjustable rate mortgage to get rid of this other debt that you have, turn it into this long-term fixed rate. or long-term adjustable rate.
Mhm.
And when you reduce that adjustable rate, you're going to increase buying power.
Yeah.
So prices go up again.
Mhm.
And that sets us up for problems in 3 to 5 years that people who plan and prepare for can be the ones who benefit from.
Yeah. Yeah. So adjustable rate mortgages, you guys are on fire today. So I looked it up last year, roughly 2%, which I'm okay with, right? There are some legit reasons for an ARM,
Sure.
usually higher end of the market, but hey, I get it. They're actually up over 4% already. So again, 4% is not concerning, but the trend is not your friend, right? They went up 100% about 10
Yeah.
months.
Yeah.
Not good. So you're right. Because again, adjustable rate mortgages today, actually a pretty big gap. We're talking about a point and a quarter. So it's, it's pretty significant. So you're right. If ARMs go from say 4% to 8 or 12%, you're right. Price is up. Here's another one for you guys. I believe this administration not only will do a 40-year mortgage for first-time home buyers, I believe they are eventually going to be kicking in $10, $15, $20,000
Mhm.
like cash
Uh-huh.
to help with the down payment. And that's going to have an immediate impact on housing value as well. So it's just going to allow more people. It's going to basically, we have a supply problem, and we're just going to, everything we're going to be doing is demand oriented. And earlier in video one, we talked about supply going down, demand coming down, but still being out of whack. You add a $20,000 first time home buyer credit initiative, whatever you call it.
Mhm.
And prices are going to go up even with these high rates, which again, aren't that high, but yeah, it's another reason, another domino that could fall to just make prices go up even more.
Well, the thing with that down payment assistance is it's a multiplier. The
Exactly.
$10,000 assistance to buy doesn't mean you can pay $10,000 more. It means, and I'm not going to be the guy that does the math on this, but if you're putting 3.5% down, that 10% equals a lot more in buying power.
Absolutely right. Absolutely right.
Just
Matt,
need to, people just start getting in line for the Biden bucks, the
Yeah.
Kamala Kwan,
Oh,
the Yellen
stop.
Yuan. They're just going to line up. I mean,
It's
that's
just
what's going to be pushed
giveaway,
into the market.
giveaway economy, or giveaway whatever.
Yeah, it's just it's counterintuitive. You want price of things to go down. Stop pumping money into the market.
Yeah. Matt, you got another one that might happen? Another domino that could fall?
So we did adjustable rates. We did 40-year mortgage. We did
Well, Matt,
geez.
thanks, Dion. You got another one that might fall?
I have a two-part.
Okay.
First, prices are going up because for the first time in our collective lifespans, we have the strongest consumer confidence. We grew up with, when there's a crash or a pandemic, you're going to lose your house. Look at 2008. It's what happens when people can't pay, it gets foreclosed on. We had an actual pandemic for the first time in our lifespans, and the government said, no evictions, you don't have to pay rent, no foreclosure, you have to offer forbearance. When they come off of forbearance, you have to offer 40 years. Here's $46 billion in rent relief. Here's COVID funds. So hardly anybody's actually losing their house because of the pandemic. The same number of people who would have lost their house is going to lose it. So we've got that confidence level so people can pay more, feeling if something falls apart, Uncle Sam will prop me up.
Yeah.
But the second thing, and I mentioned this in video one, last year and the year before, a lot of companies said you need to work at home now. So people could work from anywhere, homeschool their kids. They didn't have to stay close to work, but we didn't have confidence that that was going to stay forever. We thought in a year or two, they're going to force us all to come back to the office. So a lot of those people became renters.
Yeah.
It's over a year now. It's coming up on 2 years. People are pretty sure the companies that are going to call you back to the office already tried. Some failed. Some of the employees said nope, and only a certain percent went back. So now those people are going to become buyers, high income in low cost of living areas, paying more than they would have where they were living. Still feels like a deal to them.
Yeah. Yeah. Cool. All right. You had a two-part, or is that?
That was the second part there.
Okay.
The confidence that we're not going to have to go back to the office.
Got
Sorry.
it. Yeah, got it. Yeah, here's a couple more for you, because I've thought about this. And again, we're not calling for these, but if these happen, there's no bubble in real estate. It'll actually get bigger. What people don't realize is again, I've been doing this a long time. And what started my journey to real estate was the .com blow up. NASDAQ went down 80%. If we happen to have a stock market bear market where it falls 50%, you're going to see more and more people leave the stock market, swear off the stock market, and want hard assets. I can see it, feel it, touch it. Oh, by the way, real estate's hot, and it will just draw more people in and create more investors. Again, a stock market crash of 30% or more will actually help real estate because more investors will move over and go, hey, I'll put 40% down and have 30-year debt. So that is coming. Another one that is happening right now that did not happen before is Wall Street or big money is build for rent. They are absorbing units that would normally go to owner occs. And here's the deal. A lot of people talk about when these big hedge funds are going to sell. Folks, they're never going to sell.
Right.
They're buying these with its average of a 6% risk-adjusted return. That is awesome. They got it. They recycle their capital. They put it off in a fund and they never think about it. It's not like these things are going to come back. So we are seeing Wall Street absorb more and more. Today, they're like 1% of the market. They are big percentages in some cities, but overall, they're not there. But they are getting bigger and investors are getting bigger. So if you're in a market where where for sale homes go down, but you still lose 10 or 20% of that to investors, math says there's less supply available for owner occs and prices go up. So at the end of the day, when I think about the bubble, I see very little reason for it to go down. Bubble popped last time because we created an environment where 50% of loans were adjustable, teaser based, and you were now a forced seller. We don't have any of those things going on right now. We do have an interest rate that raced up, so you have less buyers. But again, when you look at the ratio, it's still positive. The demand outpaces supply, right, Matt?
I mean, that's what I'm seeing in my local market. Enough that it took it from $300,000 for the median income home to 440 in 1 year. That's ridiculous.
Yeah.
And it was a lot of out of state people selling their, 3-bedroom, 2-bath ranches for $1 million in Massachusetts and New York and Connecticut. And then moving here and realizing in my town, a 3-bedroom, 2-bath, Cape is, 450, 400.
Yeah.
So for them, they were able to buy for cash or they got a loan with, 30% down. So yeah, I see that. I see that continuing. I think there's certainly some markets that are going to be at risk.
Yeah.
But even if Wall Street, everyone says, well, what happens when Wall Street gets tired and they have to sell? Insurance companies are going to buy the entire portfolio of business because they need risk adjusted returns between 5 and 6%. That's what they need.
Yeah. Well, to that point, Wall Street will never sell their portfolio one at a time. It's not efficient.
No, it's whole portfolios. Agreed.
Oh,
Yep.
agreed. No.
Yeah.
People out there going, oh, they, in Phoenix, right? Phoenix is crazy hot with these hedge funds or whatever they're called. Unfortunately, folks, they aren't ever going to sell to individual homeowners. There may be onesie, twosie exceptions for some reason, but they're never going to go, hey, I'm going to list my 1,700 homes because they'll move the market all by themselves.
Absolutely.
They're going to do one deal or they'll divide it in half and sell it off. There'll be 2 big chunks or 1 big chunk and they'll be gone.
Yep. Just like Zillow did. 2,000 homes, swipe of a pen.
Done.
But they're all going to come to market.
Nope.
They weren't.
They're done.
And they didn't affect the market price at all.
At all. Nope.
At all. One bit. How much did that affect the market? Those 2,000 homes instantly selling in that Arizona market.
None.
Up only 15% more since then. Glad everyone was right on that one.
Yeah. How about you, Dan? What do you think?
Well, the other thing that we're missing here is how the age demographics are changing. And last year, the largest group of home buyers were millennials at 37%. And you're more likely to invest in crypto if you're 40 years or younger than you are if you're 40 years or older.
Sure.
And like you said, with stocks, so we're talking dominoes that could fall.
Yes.
So crypto itself doesn't take a big hit usually, but Bitcoin has dropped over 40% 9 times in the last 10 years. So there is a group of millennials, the largest group of home buyers so for last year, that if there's a correction or enough pain in crypto, they're going to look at real estate just like those stock investors would if the stock market takes a hit. So there's a big line of dominoes that all push towards prices going up.
Yeah, it's crazy to think about. I wish more and more, and again, we're not calling for any of these. These are just dominoes to watch for. Again, a lot of people are going to tell you why it's going to pop. We just wanted to go the other side and tell you what could happen. Dion, how can people find you? Oh, go ahead.
I would love anybody in the comments below to leave a reason why it's going to pop, like articulate what would make prices come down. And to find me right here on YouTube, Dion Talk Financial Freedom.
Very cool. And Matt?
Lumberjack Landlord on YouTube, Lumberjack Landlord on Instagram. And I agree with Dion's sentiment. There has to be a reason, and it can't be just cause.
You know what we're
Give me
going
a
to do? You know what we're going to do on episode 3? I'm going to be that person. I'm going to be the person that screams at you that prices are going to fall. And I'm going to give you all the reasons that I could think of off the top of my head. So that's video number 3. I'm going to tell you why it's going to crash. Watch video 3. Here we go. Thanks, guys.
Beautiful.